Stocks slipped today, and while on the surface the move looked pretty minor, the underlying reason why is anything but that. Jerome Powell just put the market on notice. He didn't deliver some type of dramatic new policy announcement. Instead, what he did is he simply reminded investors something that they already knew but didn't want to hear, which are that valuations are stretched. And history shows that when markets run too far ahead of their fundamentals, gravity eventually takes hold. So today the numbers told a story. They didn't lie. The Dow closed down 0.37%, S&P 500 dropped 0.28%, and Nasdaq slid 0.34%. Now that marks the second straight day of tech weakness, and given how much tech dominates the index, the pullback ripples across everything, and everything feels that pain. And what triggered it is yesterday, Jerome Powell's speech he had out in Rhode Island, and what he said that everybody's really dissecting apart and scratching their heads about is we don't have a view that we know what the right price of any particular financial asset is, but by many measures, equity prices are fairly highly valued. He really fluffed it up, adding the fairly part in there, but everybody had some time to kind of think about it and sleep on it, and I don't think they liked that last sentence. Equity prices are fairly highly valued. And that comment hit like a subtle warning shot, because when Jerome Powell hints at things, markets listen. Now, why do Jerome Powell's words matter anyways? Well, he's essentially acknowledged something investors already debate, which are valuations. He reminded everyone that while the Fed doesn't set stock prices, it can't ignore them either. And elevated valuations tighten financial conditions by raising the cost of capital, and that trickles down through the economy into consumer spending, corporate borrowing, and overall risk appetite. And he's not wrong about that. So let's break down three main valuation measures that are flashing red right now according to this article here on Market Watch. Fed Powell says stocks are fairly highly valued. These three charts shows he's right, by Joseph Adinolfi. And what he starts off talking about is the CAPE ratio, which is, let's scroll down to it. And that was what was created. It's a cyclically adjusted price to earnings ratio created by Robert Shiller. Looks at the S&P 500's price versus average inflation adjusted earnings over the past decade. And in late August, the CAPE sat just shy of 38. Now it gets updated monthly, and we haven't got a new update out just yet, but Charles Billoli recently noted on Twitter that, or X is now what it's called, it has crossed 40 for the first time since 2000. And back then the dot-com bubble had just peaked, and the following bear market was pretty brutal after that. So a CAPE this high doesn't predict an exact top, so to say, but it reminds everyone of the margin of safety being razor thin right now. Now, the next thing he gets into talking about is the Buffett Indicator. So the Buffett Indicator, which Warren Buffett often called it the single best measure of market valuations, it compares the total market cap of U.S. stocks to GDP. And as of June, U.S. equities were valued at about $64.5 trillion, while GDP stood at $23.7 trillion. Now, what that is 2.7 times GDP, the highest level in at least 20 years. And to put that bluntly, stock values are miles ahead of the underlying economy. And while Buffett himself warns against timing markets, the gap here is too wide to ignore, which is why everybody's flashing red sirens at this indicator. Now, here's the last one we're going to talk about. Finally, the price to sales ratio. So the S&P 500 is trading at 3.12 times forward sales, which is the highest level on record since data began back in 2000. And this matters because sales are harder to manipulate than earnings are. So corporate margins are near record highs, but using sales strips out accounting gimmicks and showed just how expensive stocks really are, relative to these corporate revenues. But is this the new normal? We don't know that. But the twist is that while valuations are extremely high by historical measures, today's market is not the same as the dot-com bust, which balance sheets are stronger, debt to equity ratios are lower, and floating rate debt is rare, making corporate interest costs more predictable these days. Then at the same time, automation and AI are driving productivity gains, reducing labor costs, so that's really helping out. And then the largest firms like Apple, Microsoft, Google, they all have stable recurring cash flows, unlike the speculative stocks, those companies of the 1990s that led to that dot-com bust where everything fell out of the sky. So some argue that these high multiples might represent a new normal where mega cap firms deserve premium valuations, but then some are, a little sketch about it. And I see reason for both sides having some form of correctness to them. Now, while Wall Street chewed on Powell's comments and I really dissected those words like we were saying, Main Street delivered a shock of its own. So we had new home sales data out today, and the new home sales spiked 20.5% in August, which was the biggest jump since January 2022, bringing the annualized rate to 800,000 homes, which is a lot higher than was expected. I believe they were looking for a number in the 600,000 figure. So that was a huge beat, and builders are slashing prices and offered incentives like mortgage rate buy downs, which is really helping these buyers because buyers are responding to that, and it's a tough economy. Interest rates are high, home prices are high, and then you got these new homes that are on average $20,000 cheaper than a used home. But there is skepticism here. So economists are warning that the seasonal adjustment may have over-exaggerated the numbers, and this timing also doesn't quite line up since mortgage rates fell more in September, not necessarily in August. And many expect the surge to fade in the coming months. Still, it's a reminder that housing demand isn't dead. There's still transactions. Transactions never go to zero. It's just waiting for affordability to improve because there's a ton of people on the sidelines. Now, looking ahead, tomorrow's calendar is completely stacked. We got all types of stuff. At 8:30 Eastern time, we get initial jobless claims. Even before that, 8:20 Eastern time, we get Chicago Fed President Austin Goolsbee, GDP third estimate, advanced U.S. trade, advanced retail inventories, wholesale inventories, durable goods, more Fed president speaking from John Williams, Jeff Schmid, Fed chair for supervision, Michelle Bowman speech, Michael Barr, Dallas Fed President Lori Logan, San Francisco, Mary Daly. We got a lot of speaking tomorrow. Markets will be looking for confirmation. Are Powell's words a warning or just an acknowledgement of the complete obvious that's in plain sight? So the takeaway we got today is that stocks aren't necessarily doomed just yet. It's just that Powell reminded everyone, hey, y'all, valuations still matter, and y'all are buying these stocks pretty expensive right now. In history, they stretch too far, volatility follows. And whether this era is truly representative of a new normal or whether gravity eventually wins, that's the debate unfolding right now that we don't know the answer to. All we could do is keep on tracking what's coming in each and every single day, covering it, hanging out together, learning together. And with that, y'all, I'll see y'all tomorrow. Y'all have a good one.